Welcome to the Sell My Business podcast. I'm your host, Jeffrey Feldberg. This podcast is brought to you by Deep Wealth and the 90-Day Deep Wealth Experience. Your liquidity event is the largest and most important financial transaction of your life. But unfortunately, up to 90% of liquidity events fail. Think about all that time, money, and effort wasted. Of the quote-unquote successful liquidity events, most business owners leave anywhere from 50% to over 100% of their deal value in the buyer's pocket and don't even know it. I should know. I said no to a 7-figure offer and yes to mastering the art and science of a liquidity event. 2 years later, I said yes to a different buyer with a 9-figure offer. Are you thinking about an exit or liquidity event? If you believe that you either don't have the time or you'll prepare closer to your liquidity event, think again. Don't become a statistic and make the fatal mistake of believing that the skills that built your business are the same ones for your liquidity event. After all, how can you master something you've never done before? Let the 90-Day Deep Wealth Experience and our 9-step roadmap of preparation help you capture the maximum value for your liquidity event. At the end of this episode, take a moment to hear from business owners just like you who went through the Deep Wealth Experience. Lowell Ricklefs is the CEO and founder of Traction Advising, which specializes in helping B2B SaaS companies with a greater than $5 million ARR get acquired. Lowell's been a co-founder, CEO, chairman, and COO of a $120 million public company, startup CRO, and global VP at Rockwell. Lowell is a global mentor, investor, board member, and CEO coach. Lowell's current business, Traction Advising, started out of his frustration when he was in a buyer's position. The investment banker model uses accounting and finance people trying to sell. In Lowell's words, no one hires accountants to sell products, so why hire them to sell a company? Selling and marketing a small SaaS company is more like selling a technology product than selling a financial instrument. With company buying and selling experience of more than 30 organizations, Lowell knows what internal stakeholders need to approve a transaction. As a founder and CEO, he knows what it's like to start up a company, build a product, hire employees, raise money, find customers, keep them happy, and make payroll. Lowell leverages this experience to craft acquisitions that get the best outcome for the founders and investors in a structured way that maximizes success. Welcome to the Sell My Business podcast. And today you are going to be enthralled with who I have as a guest and what we're going to be talking about. Because as a business owner, when you think of your liquidity event, wouldn't it be nice if you could have a crystal ball where your future self could come back in time and tell you, do this, don't do that, and here's where you really want to focus? That's some of the tidbits of information that we're going to be talking about today and doing some deep dives on. But let me not get ahead of myself. Lowell, welcome to the Sell My Business podcast. An absolute delight to have you with us. Lowell, there's always a story behind the story. Why don't you tell us what got you to where you are today?
Thanks, Jeffrey. I'm thrilled to be here. I got here in a kind of circuitous manner. I was electrical engineer, computer science graduate, and worked for Fortune 500 company Rockwell, went up the technical sales route, and then worked for 3 technology companies, scaled one from $1 million to $50 million, had an exit to WPP, and then scaled another as the COO from $10 million to $120 million. Then was co-founder and CEO of a fintech company that had an exit as well. But along the way, was involved in acquiring about a dozen companies and had a lot of interaction with bankers and was always surprised. I had a sales background, why financial background people were in charge of a sales process. They were very good with investment analysis, but they weren't very good salespeople, and they followed a structured process. So when it came time to sell the company that I co-founded, I decided to leverage my enterprise selling background to run an enterprise sales process and position the company as I would position a technology product. I felt that small companies are acquiring a small technology company is more like acquiring a technology product than it is acquiring a financial instrument. And I think they need to be presented that way. So I had that premise. We were successful selling our own company. One of our investors wanted some help running the process for another portfolio company. And 5 years ago, I realized there was an opportunity out there to help other small companies, good B2B SaaS companies, we feel run a better process to help them find the right fit, get the most value for their business, and structured in a way that makes the most sense for them.
Wow. There's so much to unpack there, Lowell. That's incredible. So you've just had an incredible amount of experience, Fortune 500, big companies to your own companies, fintechs, everything else in between. Before we talk about what you do today and some of those insights, when you look back at you with the companies that you started and the companies that you sold and bought along the way, are there common themes of, hey, do this if I want to do something really well, or at all costs, stay away from this because it leads to just a disastrous outcome?
Well, there are a lot of directions that you can go there. When I was on the founder side and raising money and talking to investors, I always had the exit slide right towards the end of the deck. And I would throw some recent acquisitions out and some potential buyers. But I didn't really know what the buying process was. And now I'm on the other side. I talk to at least 1,000 buyers a year, sometimes 5, 10 a day. So I know what they'll pay for. I know what they're interested in. And at the end of the day, the reason B2B SaaS companies are valued as highly as they are, it comes down to growth and retention. That's what they'll really pay the premiums for. The reason SaaS is valuable is because it's a reliable revenue stream. And if your retention is low, for example, if you've got 50% annual churn, people aren't really buying a long-term subscription. It's the equivalent of buying a 2-year license. So those companies are valued more like the traditional license maintenance model companies. So a lot of things in there. Revenue is everything. I think a lot of people see a problem, they solve it, and they underestimate how difficult it is to drive awareness, interest, and generate revenue growth. But to me, survival and prosperity is all about revenue, pulling in revenue. It's less even about raising money than I think it is about revenue, because then you can self-fund. And then retention. So I think a focus on retaining clients, people that stick around for a long time, and then ideally selling more to those same clients as well. So your net retention increases as well. But that, to me, the survival part of it really comes down to generating real revenue, people that will pay for your product and then stick around.
Fascinating. And for our listeners, what's interesting here is Lowell is on both sides of the table. And you know what? If you want to win at a game, you have to understand what the rules are. So Lowell, when you're sitting in the buyer's seat now, you're speaking to 5 to 10 buyers a day, 1,000 or more buyers a year, you're really getting into the mindset of these buyers. And I know at Deep Wealth, in our 9-step roadmap of preparation, step number 3, the future buyer, it's all about the buyer's mindset. And what we often share with business owners, stop being selfish. Do not think like a business owner. Don't think like a seller. Transform your thinking to be like a buyer. And I'd love to hear, Lowell, there's probably, Pareto's law that 80% of the things that buyers are thinking about are probably coming from 20%, give or take, of some common strategies or principles. So most buyers out there, when it's a B2B SaaS company that they're evaluating, what's going through their minds in terms of maybe the games that they're going to play, for starters, in terms of, okay, what can I do here? It's a great company, but maybe I can lower the price a little bit if I do A, B, C, and D. What would that be for most buyers of the types of games that they may play?
Yeah, really good question. And I think it's true in sales with selling your company or selling your product. People really don't care about your company or you. They care about themselves and their problems. And so to the extent that your product, your company solves a problem that they have, they're interested in. So I feel that you should understand the buyer, understand what they're trying to accomplish, and then talk about that. Don't talk about my name is so-and-so, my company is this, we do this, this, and this. You have a hole in your product portfolio that we can fill that helps to generate revenue and EBITDA for your investors. Put yourself in their shoes. And it really depends. I'll say there are 2.5 categories of buyers, and they're starting to look somewhat similar. So you've got strategics, which are real companies that have real clients and customers, and they're trying to grow. And then you've got financial buyers, a group of people that are trying to invest someone else's money to make money on their money. For small SaaS companies, though, they start to look a little bit similar. And here's why. The financial buyers, typically private equity, they own a platform company. Well, a platform company looks like a strategic. It's a real business that operates. But they're typically very active in buying add-ons. So companies with 2, 3, 5, 10 million in ARR can be added on or bolted onto these platforms. So, some things are different. If you're greater than 10 million in ARR, you might be a platform company. We could spend a lot of time on this. I'll keep it short. But as a platform, they'll build around you. So your financials matter because the only way you can grow is organically or through acquiring other companies. With a strategic, you might have 100 clients and a strategic buyer may have 50,000 clients. To grow from 100 to 200 is a lot of work. But if you're acquired by a strategic, really all they have to do, I'll oversimplify it, is a marketing campaign to introduce your product to their 50,000 clients. If they get 10% adoption in their clients, they've got 5,000 new clients. You're 50 times the size you were. That's why strategics can often just genuinely rationalize paying more for the business than a financial can. Things to watch out for. You definitely want representation. What do people try to do? Things to watch out for on the private equity side in particular is to make sure that they've spent the time to understand your business. The first part of a process that will run will ask for indications of interest. And there might be 5 or 10 or 20 people that are interested in buying your business. What people will sometimes do is they'll give a high bid to make it to the second round of the process without really doing any work. And you may choose them only to find out, only then will they do the hard work of the due diligence, and then they'll retrade it. They'll reduce the price. So I look at certainty as a big deal. This is a lot of work and expense on both sides. You want to make sure that you understand what concerns the buyer might have. Because yes, you're selling and you're trying to put on your best face, but you want, at some point, you're going to know everything about each other. It's important to expose everything, good and bad, to de-risk it before you get to the purchase agreement stage. With strategics, what I see, it's a little bit different. Often they'll do their due diligence internally. You may have non-expert acquisition people. You might have a CTO who's not an expert at doing due diligence, a VP of HR. You may have SVP of sales, people who are very good at what they do, but acquiring companies isn't their primary day job. So that's where I feel the fact that I've been on the acquisition side, often I've actually had more experience acquiring companies than the acquirers. So even though I represent the seller, I help coach the buyers on how to structure and how to do diligence, things that are important. It's also understanding how it gets done on the strategic side is that they'll sit around a table. You'll have HR, you'll have product, you'll have sales, and they'll talk to each other. And all it takes is for one person to raise their hand and have an obstacle that can kill a deal. So staying close to each of those individuals, understanding if they have any concerns about moving forward, and then addressing those concerns. Often there are things that can be addressed to make them go away. But if they're not addressed in a timely fashion, they can take on a life of their own and the company's interest will drift away.
Fascinating. Lowell, let's flip the tables now. Let's talk about the sellers, the business owners, the founders, entrepreneurs that you're representing. And I'll speak from my own personal experience. Unfortunately, it seems, because it's not an easy way, it's the hard way. I find that I learn more from failure than from success. That's just, at least for me, the way that it is. So when you look at some of your clients in the past, are there common mistakes that business owners are making that if they knew this in advance, if they could come prepared in these few areas, it would make the world a difference? And if there is, what will those areas be?
A couple of areas. One has to do with just properly preparing your business. Like if you're going to sell your house, they'll tell you that paint it neutral inside, stage it with furniture, cut the grass. There are certain things you can do to bump the price. There are things companies can do. If you've never done a price increase, you can run a price increase to increase your net revenue retention. When you're trying to bring in new clients, you'll sign up anyone and everyone. And if they leave, you don't care. At least they paid a little bit for a while. That can negatively affect your retention metrics. So that's an important one. If they're not truly a subscriber, if they're really just a trial, make sure that they're counted differently. The other thing that I see comes down to small companies, particularly if they're bootstrapped, if they've not had to professionally report their financials before, their financials may not be clean. I'm not saying that there's anything like integrity-wise wrong. That's a whole nother level of problem. I'm just saying that sometimes the part-time bookkeeper, as long as your actual intake of cash is greater than your expenses, things are fine and you pay your taxes. But a buyer will want accrual-based financials up front. They may buy the company based on your cash-based financials. But one, make sure they're accurate. Make sure all the expenses were actually logged. Make sure all that your revenue is properly logged. But also, there are some things in accruals that can be a little bit tricky. For example, if you collect on annual contracts, you'll have on your balance sheet, you'll have some unearned income, which is a surprise to many sellers because they say, oh, I've got $2 million in cash. I'll keep that. The buyer comes in and says, yeah, but you've got $3 million in unearned income. You've collected revenue on future services that the buyer will have to provide, and they'll deduct that from the sales price. So that's something more just to be aware of. And there's a little bit about more as a learning about like net working capital. It's something that always gets negotiated at close, and that can be contentious, but it's often something that even the smartest business owners struggle to understand that net working capital target, because it feels like that comes out of their pocket if it's not negotiated properly.
Now, it's interesting. We're talking about accrual-based accounting systems, but we're also talking about SaaS-based companies. And I know in certain circles, you have this whole discussion that really the business model, the accounting of a SaaS-based company is really different than the more traditional accrual-based kind of company. So is there a case to be made, Lowell, of having a SaaS-based kind of accounting put forward as opposed to the more traditional accrual, just given how the business model works and how the business operates?
Yeah, SaaS companies compared to one of the companies we had 13 offices in 10 different countries, and we had intercompany transfers and foreign exchange. So financially, SaaS companies tend to be fairly simple, but where it does start to get a little bit complicated is with some of the metrics like cohort analysis, but also the accrual financing. But like I say, it really comes down to, so you don't have accrual, like you don't have projects that you have to account for. This project's 20% complete. This one's 40% complete. How much can we count as revenue? But it really kind of comes down to, do you bill monthly? Do you bill quarterly? Do you bill annually? Usually it's monthly or annually. And that's one where if you've got cash accounting, you may not even have thought this through before. You just look at your cash balance and say, well, I've got cash on the balance sheet. I'm going to want to try to keep that. But I can promise you that the buyer, even if you don't do accrual financing, they will do a quality of earnings and they will determine what the equivalent accrual finances will be. And again, that unearned or deferred revenue piece that they feel is something, it's a liability to the company. And the problem is many founders have already spent that money, or even worse, they don't have any money on their balance sheet and they've got $5 million in deferred revenue and they sell a company, I'm making this up, but they sell the company for $50 million and they want to deduct that from the $50 million sales price to make it $45 million.
And somewhat related, different, but related. And it's something that often comes as a surprise for business owners. I'll broadly classify it as EBITDA adjustments. Perhaps they're business-related expenses. I mean, hopefully they're business-related expenses, but they're lifestyle expenses. So things like, I'm just making this up, perhaps it's having seasons tickets to your favorite sports team, or you're going to the opera or the ballet, or maybe you've decorated the office in a particular way that's more for your taste than the run-of-the-mill kind of thing of what you'd see out there. What's your take on EBITDA adjustments, and how do you best protect yourself even before the liquidity event starts? What are you seeing out there?
Yeah, it's common to provide, and it's very typical. And buyers know, they understand that as a founder-owned company, your goal is to minimize profits, not maximize profits. It's to minimize it so you don't pay taxes on it. So they understand that you might go out and buy a $120,000 Tesla X because you can depreciate at 100% because it's over 6,000 pounds as a company vehicle. They understand that there are expenses in that business that wouldn't be in the ongoing entity. And they will question all of it, but it's very common to go in, we call those add backs. You pull out the things that wouldn't be a normal business expense when it's owned by the new owner, like whatever that might be.
And you know what's interesting, and we talk about this in the Deep Wealth Experience, it's our due diligence module. And it's really a bittersweet pill, because our thinking on this is, our thesis is, if you don't have to do it, don't do it. Because why put yourself in a situation where, number one, the buyer can make a judgment call? Well, look at this. If the business owner is driving a Tesla, where else are they overspending in this business that I should help be taking a closer look at? Or the buyer simply saying, I don't agree with you. You can't prove it, so I'm going to keep this in. It's not going to be an add back, and you're going to have to suffer the consequences of that. And when you think about it, Lowell, I'm just making up numbers here. Even though you're paying higher taxes because you're more profitable, if you're getting 10x or 15x or 20x, whatever that number is, it's really, in the scheme of things, a rounding error. It's a small number to pay by having what I'll call cleaner types of books with no EBITDA adjustments or minimal EBITDA adjustments than having to go back in after the fact and trying to explain anything. But let me do this. So you're on the other side and you really raise a terrific question. It's a sales process. So no offense to all these brilliant financial people out there, but why the heck are they leading the process as opposed to having a professional salesperson lead the process? And you found a pain point in the market, a niche in the market, and you began to address that. I'd love to hear what you're finding in your world today as you take your sales expertise and you have your sales hat on. And you're a smart guy and you understand the financials and you're incorporating all that in there, but it's really a sales forward approach as opposed to a financial or accounting forward approach. So what's going on out there in your world and what are you hearing? What are you seeing?
Well, I'll tell you what, super brief history lesson. 2002, Enron did some bad things. Sarbanes-Oxley was put in place to hold CEOs accountable. It added 1 to 2 million in cost for a company to go public. It made it difficult for small companies to go public. In steps private equity. Basically, they took over the low end of the public stock market, and they have a 5-year plan, which you could argue works better than these quarterly earnings. They did really well, 40% internal rates of return. So funds were worth 10 to 20 times what was put in. Flash forward to today, there's nearly $5 trillion in money in private equity firms. That's just below the GDP of Germany. So there's a massive amount of money out there. People have SaaS multiples and publicly traded companies have doubled in the past 2 years. So digitization has accelerated. But people really understand the value of this recurring revenue. So the short story is there's a lot of money out there. There's more capital trying to be deployed than there are available opportunities. So it's a good time if you need capital to be raising capital. It's pretty lucrative. The prices are high. But you're right. I don't know that they're any smarter, the salespeople or the financial people. They're just different skill sets. I would argue salespeople make lousy financial people. You're not going to hire a salesperson to run your financials because they won't do a good job. But I would argue most founders have never hired a financial person to sell their product. So that kind of makes you think. And you wouldn't, if you're going to sell your house, I'll use that analogy, you wouldn't hire a bank to go sell your house. It's just not their natural skill set. The reason they're in it is historically for investment analysis, again, complex financials, foreign exchange, when you've got asset intensive business, it's very complicated. It's probably, I'd argue many of those businesses are 70 to 80% a financial exercise to understand what is your return on invested capital. But for a SaaS company, financials are pretty simple. So it's a technology. In theory, it's infinitely scalable. It's not like these intensive businesses. So understanding the buyer and truly what their strategic roadmap is in painting a picture of their success being better as a result of acquiring this business and helping them with that model together. And it's pretty busy. We've done 3 transactions this year. We've got a 4th that we've got offers in on, a 5th that we're working on, and another company that we're talking to. We're as busy as we'd like to be, and we're pretty selective about who we work with. It's a stressful process for CEOs to go through this. I'd argue it's one of the more stressful things that people go through. So we've got a pretty high bar for integrity and character of the kind of people that we work with. So we're pretty proud of the alumni group of people that we've worked with in the past.
It's a terrific success story. Congratulations with that. And so if I put myself, I'm the founder of a SaaS-based company, and I come to you, Lowell, at Traction Advising, and I'm saying, okay, here I am. I want to have some kind of liquidity event. Please take a look. Lowell, what are you looking for that would have my company make the cut for you to say, yes, we've taken a look, we're going to work with you. So let's start there. What does that look like of you saying, yes, come on board?
Yeah, part of it is I do CEO coaching. And part of why we do this is to help people. I understand what it's like to have an idea and a business idea on a napkin and to get your first, $80 of revenue. I've got a lot of empathy for founders. I've got a lot of empathy for angel investors, VC seed funds, and investor seed funds as well. So initially, my goal is just to be helpful. So I'm happy to talk to people. We don't engage officially with the vast majority of people that we interact with, but I'm happy to give free advice and coaching to anyone that is interested, that's looking for help. But specifically for the companies that we engage with, companies 5 to 20 million in revenue, 5 to 10 million is probably where the majority of the companies are that we work with. One of the things that we look for is alignment of expectations. I've talked to people that have, they've got 200,000 in revenue, and, I'm happy to talk to them about what things look like. And they'll say, I would take 50 million for my company. You know what? Maybe you'll get that. I'm not going to say you won't, but I'm not going to be able to tell you that I can do that for you. So part of it is alignment of expectations. So based on the buyers that we know and we talk to, do I believe it's reasonable? Do I think someone will pay that? So that's part of it to make sure that we're on the same page. I don't want to engage with people if I don't think there will be a successful outcome, which again is a little bit different. Larger investment banks, I've got a business partner in London. He and I each work on 1 to 2 deals a piece at a time. Bankers often will have 7, 8, 9, 10 each at a time. So it's more of a bring as many in the front door as you can and try to close 50%. Our goal is to close 100%. We close about 90%. So we're very hands-on, so kind of selective. So back to your original question, the revenue range is one part of it. Is it interesting? Like, we talk to buyers. We have a pretty good idea of what there's an appetite for. That we look at the total available market size. Is it big enough to be of interest to a potential acquirer? And then we'll look at some of the basics. We'll look at their logo churn. We'll look at revenue growth. We've looked at companies that are low growth, and we've actually represented companies that have negative growth. Negative growth is difficult. I've heard the expression from a buyer, no one wants to catch a falling knife. So negative growth isn't good. But so some of the basics that our buyers look at, we kind of vet just to make sure that we're confident that we can deliver on. Our goal is under promise and over deliver, but to try to always get more for the founder than they thought they could.
That's interesting, Lowell. So as a founder, I come to you, you take a look at my company, there's an alignment of interests, my revenues are in the right range, and you say, yes, come onto the team, we're going to now start working with you. So what happens next in your process, Lowell? What should I expect as a founder now that you've taken me on and we're looking to have a liquidity event?
Yeah, great question. So initially, we'll do extensive research with the strategic buyers, and we'll create segments. So there's a segment of buyers. Let's say you've got a North American presence. Well, there are European companies, there may be Asian companies that are looking for a presence in the US. So they may do the same thing, geographic expansion. There are other companies that you have a very specific solution, and it may be a part of their broader product portfolio. So we'll create segments of companies really based on why they would buy you. And then we'll vet that list. We'll look at recent acquisitions. We'll look at number of employees. Are they growing or shrinking? Do they have capital? So we'll kind of vet how likely are they to be able to buy you. And then we'll look at the company's stated strategy as well. And then separately, we'll create a list of the different financial buyers. We've got about 300 that we work with on a pretty regular basis. And we'll identify those that look like a good fit. And then we'll create a marketing deck. We call it a confidential information presentation. Again, fundamentally different than the two-tone banker decks that they'll put together. They're very comprehensive, typically put together by new analysts, like freshly minted MBAs, very smart people, but usually their first job is banging out PowerPoints. They don't typically tell a story, the banker's version. It's 100-page thick document full of facts, figures, trends, et cetera, that I would argue as a CEO, if you sold your product that way, you probably wouldn't be very successful. If you sent a thick deck to people and said, read this and tell me if you're interested, I don't think you'd get a great response. So we really approach it from the point of view that we really try to simplify it. The classic expression, apologize for the length of my letter. I didn't have time to write a short one. We take the time to write the short one. We try to get the essence of why the company is great and the essence of why your company will be better if you buy this company. So we try to make it crystal clear so it doesn't take a lot of effort to read it and understand it. And then the financials put together a financial model, which is pretty typical. And then we'll reach out. We'll have kind of initial conversation. If they're interested, we'll do an NDA, send them the SIP, and we'll do what we call a fireside chat with the CEO, typically kind of 30-minute introduction with the founder can do diligence on the buyer kind of get a feel for the company and hear the story. If it looks like there's interest longer term, we will engage a little bit further. Typically 6 to 8 weeks later, we'll require indications of interest. So it's a loose LOI, but it gets rid of the tire kickers, forces people to put pen to paper. How much do you value the company? What does the structure of the deal look like? What's the source of your funds? What further diligence would be required to get to a defined agreement? What other approvals are required internally before this deal gets done? From that, we'll select a short list, spend a lot more time digging deeper, and then get to an LOI. Negotiate the best possible LOI. The super due diligence is kind of the final part, the most exhausting part for the founders. And then sign and close and refresh your bank account for the money to appear. It's literally how it works.
Terrific. And thank you for explaining your process. Lowell, I'm wondering, because you're focused on the SaaS space, particularly in B2B, do you find that you're bumping into the same buyers again and again, or is it different buyers that you're interacting with?
It's a mix of both. So particularly on the financial side, we talk to a lot of the same people again and again. So we get to know them pretty well. On the strategic side, it's a mix. There are some that we work with repeatedly, but we're constantly finding new and different strategics. It depends on their strategy. And sometimes you'll find a company that doesn't compete and isn't on your radar, but they sell into the same client base and they're struggling to grow, but they realize we could sell your product into our client base and increase our revenue by 10 or 15%, even if they're unrelated products.
And what's interesting about that, and I'll throw the question your way. So really, I don't think you disagree when I say that you're a specialist both in the industry and at least on the financial buyer side. You know who the players are. You've dealt with them. Perhaps you do a number of deals with them over the course of a year and year over year. And if you contrast that to a generalist, so a generalist doesn't know the industry, they're going to presumably cast a wide net to bring buyers into an auction process of sorts. How would you compare the differences with you as a specialist to, say, someone who's a generalist, and why the advantage over what you're doing as a specialist?
It's a really good question. I'll go back when I was buying companies and we had bankers, all very smart, but I just generally found that they weren't helpful to me. You could tell they were rushing, just trying to get a process done, get meetings set up, like answer questions. We'll spend the time. Part of it is the credibility. I've been a CEO, COO of multiple companies. I don't say it to brag, but when I talk to the CEO of multiple publicly traded companies and I sit with them, much of my career has either been as the CEO or as the COO, as their right-hand person, helping them put together business plans is what my career has been. So when I sit and explain things to them, it's very different than, again, no offense to these bankers, they're very smart people, but they've typically not owned a P&L, they've not started a company, not run a company. If you've been through all that, you're kind of in a small circle of people that kind of understand the pressures that go on. So part of it's the credibility, often generate a strong level of trust with the founding CEOs. Part of our network of referrals actually comes from the buying CEOs who will say, hey, these guys are different, like they get it. So part of it is we're smaller, we try harder, we've got more of a holistic view. Yes, we can do the financials, but for example, in our meetings, we're not just looking at the numbers, we're reading the body language of the potential buyers to find out whose head is nodding, who's concerned, who's not paying attention. So we can identify the people that could make this thing go south, understand what their issues are to try to make this thing successful going forward. Mark and I were very, very good enterprise salespeople. That's what we're good at. And we apply that here. And, statistics will show that the best salespeople, are 5 to 10 times more successful than even the mediocre ones. And we've found that applying those same styles, techniques, and asking questions, we're getting similar results.
So what's interesting, and for our listeners out there, here's some really important takeaways. So Lowell is speaking with you as really one of us. He's been a business owner. He's also been in very large companies, Fortune 500 companies. He's sold businesses, and he's coming to you and saying, hey, I have been in your chair. I've been there and I've gone through this process, didn't like what I see. And as a result, now I'm going to bring my background, my sales expertise, and I'm going to do this in a little bit of a different way. I'm not going to be the largest one out there. I'm going to be very focused, going to have a very high completion rate. And oh, by the way, I'm very passionate about sales and I'm very passionate about M&A in general and just getting that done. And so as business owners, we all have to take a step back and ask what's really important to us when we're finding an advisor. And you better be having an advisor to help you have your liquidity event or your exit, because this is the largest, single, biggest, most important financial decision of your life. And rhetorical question intended, how can you master something you've never done before? You simply can't. So Lowell comes along and says, hey, I've been down this journey many, many times. Let me share my wisdom and my experience with you so that you're the benefactor of that. And so Lowell, when you look to some of the most successful liquidity events that you've had, if you could share with the audience 2 or 3 strategies of success, what would that be for them?
Thanks. The easiest, or maybe the hardest, is for the business itself, to have a good business. But I think how you represent the company, like whether it's the fireside chat or if they're excited about having you as a part of the business going forward or a part of your team, key elements of your team. Sometimes I talk to founders who are like, hey, I've been doing this 12 years. I'm done. I'll do a transition. I want out. Having a great business is the first part. Like I say, that's the easiest, but it's also the hardest. But also how you represent it and an ability to talk to it in a way that the buyer cares. And then the integrity of everything that they see. So if the first thing that we approach them with when we talk about logo churn, net retention, revenue growth, et cetera, as they start to do diligence, if the numbers start to shift, if things were exaggerated, it starts to reduce the comfort level they have with it. So if things are consistent from start to finish, that's probably one of the best things that a person could possibly do. The other one would be the ability to move quickly. So once you're in a process, yes, there are a lot of analytics that get run, a lot of analysis that gets done. But at the end of the day, there's some emotion involved on both sides. And so understanding that their level of interest and excitement will wane over time. If you take too long to get things done or respond, that you risk multiple things can happen. One, your business, you could lose a big client that could scare them away. They may be approached with another company that looks more interesting that they get excited about. So just the ability to move quickly before things change. There's a saying, time kills all deals. Not necessarily true, but there's an element of truth to it that it's important to move quickly.
Absolutely. And like we say at Deep Wealth, 2 words, simple words, speed wins. Particularly when you're the seller. Speed wins. You never know what tomorrow brings. Speed wins. And the better prepared you are, that's what we're all about with our 9-step roadmap of preparation. The better prepared you are before your liquidity event. You have a professional advisor like yourself. You can really extract on that speed wins and off you go and you cross the finish line and beat out some of those uncertainties. I mean, who knows what tomorrow brings?
Yeah. Well, in the preparation side, I can't impress on people enough how hard people work 5, 10, sometimes 15, 20 years to build a business. And most of the time, if not almost always, spend almost no time prepping it up to be sold, which is what you're all about. I mean, and I use the house analogy. A small amount of effort to prime it up can get you another, at least 5 to 10, maybe 20, 30, 40, 50% more. So if you were to change your business fundamental, you might have to spend 5 more years sweating through it, where sometimes relatively easy. But I get it. People are wired to do what they do to be successful, and prepping it to sale is just a little bit different.
Well, you are preaching to the choir here at Deep Wealth. And because people come to us and listen, we have a 90-day system to master the 9-step roadmap of preparation. But we're very clear to tell people, if you're coming to us and you're thinking about having a liquidity event a month from now or 3 months from now or 6 months from now, you probably should go elsewhere because we can't really help you. Because for us, if we could wave our magic wand, it's minimum 2 years, ideally 3 or more years to prepare. But in that preparation process, the strategies of preparation are really the strategies of growth. So you tell me, you keep a thriving, profitable business forever, or you sell it tomorrow. You have a choice. And the point is you have a choice. But that's us. I'm curious in your world, Lowell, if someone were to approach you and say, hey, Lowell, I've got this incredible SaaS company. We have this, just a terrific trajectory. How long should we be preparing before we come to you? What's your cup of tea on that one?
I think people from formation should at least think about what it's going to take to exit. And some of that starts with intellectual property agreements for all employees. If it's the 2 of us in a coffee shop, you're not that worried about it. The buyer's going to care if they find out that, so Jeffrey wrote half this code and he didn't sign his IP agreement for 6 months after you were founded. Technically, that's a risk. And if the founders don't part friends, getting that person to sign 8 years later can be difficult. As a minimum, stressful or expensive to get them to sign that so that the deal can go through. So I think from the start, but realistically, I think that people that probably have the best exits started thoughtfully at least a year in advance. Are there some things you can do in the months beforehand? Sure. But realistically, I think the people where the exits have gone the cleanest, they're just well prepared for it. The deal that was the fastest for us, 4 months start to finish, they had thoughtfully thought out 1 to 2 years ahead of time and put the right things in place. So there was no rush. It was part of a thoughtful plan process, and the exit went smoothly. I think it reflected that. And I think the value they got for the company reflected that as well.
And for listeners, did you pick up on that? Did you hear that one number that Lowell threw out? It was 4 months. So a company that prepared well in advance, start to finish, 4 months. And you compare that, it's always a little bit up or down either side, but typically you hear 9 months. 4 months, 9 months. And if you think about it, 4 months, well, that's less due diligence, less time in market, less risk. It's really the place to be. So Lowell, let me ask you this as we begin to wrap up this episode, and there's been so much wisdom here. I want to turn to another kind of wisdom for you. And here's the question. I want you to think about the movie Back to the Future. And in the movie, you have this magical DeLorean car that can go to really any point in time. So imagine, Lowell, it's tomorrow morning. You look out your window and there's the DeLorean car. Door is open. It's waiting for you to hop on in. And you can now go to maybe Lowell as a young child or an adolescent or a young adult or whatever the period of time would be. What are you telling your younger self in terms of, hey, Lowell, don't do this, or here's some lessons learned, or here's some life wisdom? What would that be for you?
Yeah, I think on a personal level, I was Fortune 500 company. I had a good career, but I really think I thrived in the startup community where we're making good decisions quickly worked out better than taking a year to do something extremely thorough. And I think I would tell myself I would have been a CEO sooner and surrounded myself with wise people from the different functional areas, as opposed to I felt like I had to be an expert in all of those different functional areas before I could be a CEO. I think run sooner, surround yourself with wise people. Make sure you've got the right people, though. I think it's easy to pull in some people as advisors that don't turn out to be as helpful or as wise as you thought they would be. And again, on the company side, if you're a founder, is the focus on revenue and revenue growth. A lot of young founders I see focus on fundraising, but the reality is fundraising, the first exit, I think, is when people realize that, oh, people get this. They're not giving you money. You're giving them shares of the company and you're giving up control of the company. And an exit, you may not get as much. You won't get as much. But yeah, a lot of them chase the headlines in the paper, which I get, and it can be helpful, but don't raise any more than you need to and focus on generating revenue as quickly as possible.
Words to the wise and some terrific insights and life strategies there for everyone to follow. So Lowell, as we wrap this up, and I'll put this in the show notes, so for our listeners, it's point and click. It couldn't be any easier. Lowell, if someone wants to reach you online, what would be the best place?
Yeah, you can reach me directly at lowell@tractionadvising.com. You can look at our website. It's tractionadvising.com, and take a look on LinkedIn. LinkedIn is my go-to place. And I've got some things posted on there that might be useful to people as well.
Terrific. And we'll have all those in the show notes, so it'll be really easy. And on that note, Lowell, as we wrap this up, a special thank you for really taking part of your day and spending it with us on the Sell My Business podcast. And as always, please stay healthy and safe.
Appreciate it. Thanks, Jeffrey.
The Deep Wealth experience was definitely a game changer for me.
This course is one of the best investments you will ever make because you will get an ROI of 100 times that. Anybody who doesn't go through it will lose millions.
If you don't have time for this program, you'll never have time for a successful liquidity.
I mean, it was the best value of any business course I've ever taken. The money was very well spent.
Compared to when we first began, today I feel better prepared, but in some respects, maybe less prepared, not because of the course, but because the course brought to light so many things that I thought we were on top of that we need to fix.
I 100% believe there's never a great time for a business owner to allocate extra hours into his or her week or day. So it's an investment that will yield results today. I thought I will reap the benefit of this program in 3 to 5 years down the road. But as soon as I stepped forward into the program, my mind changed immediately.
There was so much value in the experience that the time I invested paid back so much for the energy that was expended.
The Deep Wealth experience compared to other programs is the top. What we learned is very practical. Sometimes you learn stuff that is great to learn, but you never use it. The stuff we learned from Deep Wealth experience, I believe it's going to benefit us both.
I've done an executive MBA. I've worked for billion-dollar companies before. I've worked for smaller companies before I started my business. I've been running my business successfully now for getting close to a decade. We're on a growth trajectory. Reflecting back on the Deep Wealth, I knew less than 10% what I know now. Maybe close to 1% even.
Hands down the best program in which I've ever participated. And we've done a lot of different things over the years. We've been in other mastermind groups, gone to many seminars, workshops, conferences, retreats, read books. This was so different. I haven't had an experience that's anything close to this in all the years that we've been at this. It's 5-star, A+.
I would highly recommend it to any super busy business owner out there. And deep wealth is an accurate name for it. This program leads to deeper wealth and happier wealth, not just deeper wealth. I don't think there's a dollar value that could be associated with such an experience and knowledge that could be applied today and forever.
Are you leaving millions on the table? Please visit www.deepwealth.com/success to learn more. If you're not on my email list, you'll want to be. Sign up at www.deepwealth.com/podcast. And if you enjoyed this episode of the Sell My Business podcast, please leave a review on Apple Podcasts. Reviews help me reach new listeners, grow the show, and continue to create content that you'll enjoy. As we close out this episode, a heartfelt thank you for your time. And as always, please stay healthy and safe.